A lot has happened in East Africa that's keeping you busy. Most of those countries of the EAC region are seeing very, very volatile currencies, high inflation, and just a lot of sensitivity. In your view, is it an aberration? Is this something that's just happening temporarily, or is this a problem that's here to stay?
And we can add to that list expanding trade deficits as well.
Yeah.
What we've seen in East Africa for the past year and a half or so is that import demand has grown quite substantially. And as a result of that, we've seen trade deficits widening, we've seen current account balances coming under pressure, and as a result of that, currencies have come under pressure as well. So there's been real flows that have driven the demand for dollars in the market that have led to the depreciation of those currencies. So the weakness of those currencies is driven largely by those real flows. The inflationary pressures that we saw, for the most part, has been caused by food price pressures. But those food price pressures are starting to ebb now, and we expect that before the end of this year, we're going to start to see food inflation peaking in most countries in the region, and going into next year, we're going to see inflationary pressures actually declining. So the measures that have been taken by policymakers in the region to try to support those currencies are likely to work now relative to, a few months ago, because they've done the right things. They have tightened monetary policy quite significantly. I mean, if you were talking about the Central Bank of Kenya, at the beginning of the year, whenever they saw liquidity tightness in the market, they injected liquidity, and the currency depreciated as a result of that. But what they are doing now is actually withdrawing liquidity, even though the market is already tight, and injecting dollars into the market is likely to work better now than would have been the case
There seems to be a bit of a lag, though, Phumelele, in the sense that we've seen very aggressive rate hikes, both in Uganda and in Kenya recently. But still, interest rates at somewhere in the region of 12%, for instance, in Kenya, don't even compare to inflation at above 17%. And for anybody wanting to invest in Kenyan assets, that's just an untenable situation. So it does create a bit of an ominous situation for the carry trade.
Well, the CBR, the central bank rate, is at 11%. But if you look at the repo rates that the rates at which they were able to do those repos are above 17%. So already, I think it's become very clear that the intention of policymakers is to actually tighten monetary policy further. They've communicated that quite clearly. Interbank rates are already above 17%. So we are getting to a point where, if you look at Kenya, the Kenyan shilling, that currency is going to start looking attractive again. Uganda already, the Ugandan shilling already looks attractive already. Even though inflation is at 28%, rates are around the 24–25% level. It looks attractive.
Return on investments, because we've also seen, obviously, with interest rates going up, treasury bill rates have gone up, but there is just a small margin in terms of rates of return for anybody looking into the fixed income side of the market. Well,
it depends on what your investment horizon is. If you've got a 1 year, let's say, horizon, if you're getting paid 24% in Uganda, there's no way that inflation in Uganda over the next 12 months is going to average 24%. It's going to be less than that. Our expectation is that, yes, over the short term, over the next 3 months, you might see inflation rising, maybe somewhere between 30 and 33%. But it's going to peak at those sort of levels. And over the course of next year, we're going to see inflation coming down quite aggressively, because food prices are going to be the main driver driving lower inflation. On top of that, you've got oil prices, which have not continued to accelerate. If in this current environment that we're facing now globally, we don't see oil prices rising further, we don't see the currencies declining or depreciating further, then the inflationary pressures are going to be under control. So the outlook for inflation over a 1 year horizon, in all probability, is going to be lower than where we are currently, and on average, you are going to be getting a positive real return.
Certainly those looking at Kenya are very concerned about the fiscal side of the economy. You mentioned those widening deficits, and it's expected that heading into an election year, there's going to be a lot more government spending in an economy like Kenya, and that doesn't bode well for just fiscal tightening and management in that respect. So when you're so bullish that inflation will come down, spending is not coming down on the other side of the equation, and there is a sense that it's not going to counterbalance this issue around the shilling, So definitely for Kenya, people are not really sure which score to call.
Well, it's a difficult one for Kenya because currently, over the past 4 months or so, we've seen that demand for paper has been very subdued. So much so that, in fact, in the first quarter of the fiscal year that ended in September, the government was not able to roll over maturing T-bills because demand was so lax. So there is potentially an issue there, but they've already indicated that they are going to go offshore to raise that funding. Then the issue that is in my mind is how quickly can they actually get that offshore funding, and between now and that time when they actually do obtain that offshore funding, what's going to be the situation in the market. So there is a chance that interest rates might rise further than they are currently. But I mean, in terms of the currency itself, I think you can separate the issue of the currency from the interest rate and fiscal outlook. The currency on its own, what the policymakers are doing, I think, is going to be supportive of the currency. There is another issue with regard to the financing of the budget and interest rates that might be, a separate issue.
Okay.